Assalamualaikum warahmatullah and good day everyone. Welcome to topic 2 of the short course Keeping It Balanced. In previous topic, I have introduced you to the role of accounting in business, forms of business entities and types of business activities. I have also introduced to you the three main reports of financial accounting, or what we call as financial statements. In these financial statements, I have highlighted the elements of each statement. In income statements, we have an income and expense that will result in either profit or loss for the financial year. In the statement of changes in equity, it is all about equity. And in the balance sheet or statement of financial position for corporation, we have assets, liabilities, and equity. So basically, we have 5 groups of items in these financial statements, namely assets, liabilities, equity, income, and expense. In this video, we will briefly discuss these 5 elements of financial statements. Before discussing the elements of financial statements, I simply want you to know that for corporation, by the International Financial Accounting and Reporting Standard, there are 5 components of financial statements, 4 statements that I have shown you in topic 1 and 1 notes to the accounts. Just so that you know, notes to the accounts is very crucial in financial reporting. This is where accounting policies, of which the reports were prepared based on them, are presented. This is also where details of information presented in each financial statement, where necessary and relevant, shall be presented. These notes will help users to understand why certain figures presented in the financial statements are as such. Coming back to our main topic for today, the elements are assets, liability, equity, income, and expense. Whatever items in your business that you want to report in the financial statements must be classified under one of these elements, and we will see that some business transactions or economic activities influence one or more than one element. Just a heads up, when recording transactions, we will follow the accounting equation that says assets must always be equal to liabilities plus equity. Must always, and this is how we make sure that our accounts are balanced at all time in accounting. Before we discuss the definitions of each element, let us first discuss why is it important for us to understand these elements. Basically, these elements are the very foundations of bookkeeping and accounting. In other words, all transactions will be captured by only these elements in your financial statements. When we record transaction in accounts, we will come across debiting and crediting the relevant accounts, which determine whether the account will have an increase in its balance or a decrease in its balance. The effect will be determined by the element that you are dealing with for that transaction. So whenever you want to record a transaction, you will ask the questions of which element or elements involved in the transaction. In previous topic, I have also illustrated to you the importance of these elements using this chart. In short, all transactions, regardless of business entities, will be recorded and classified under these 5 elements. Thus again, it is very crucial that we understand what these 5 elements are. Let us look at the first element, assets. 3 keywords for definitions of an asset. Number 1, a resource controlled by us, meaning it will give us something or a source of a benefit to us and it is controlled or owned by us. Number 2, as a result of past event, that means there was a transaction that resulted in us owning it. Number 3, future economic benefits, meaning in the future it will give us economic or monetary benefits. Now imagine that you own a business. Regardless of size, what would be your assets? Can you think of something along the definition? Let's say a delivery business owns a delivery van. How can we decide that van is indeed an asset to the business? By referring to the definition, we can say that yes, the van is an asset to the business. This is because the van was purchased by the business in the past, thus now owned by the business, and it has control over it. And the use of the van, that is to provide delivery services to customers, will earn the business some money, and that is the economic benefit. So we can safely say that the delivery van is an asset to that business. Assets can be further classified into two: current assets and non-current assets. Current assets are assets that are expected to be realized in cash or consumed within a year or less through normal operations of the business. Non-current assets are tangible assets used in the business that are of a permanent or relatively fixed nature, and usually will be utilized or used or have a lifetime or useful life of more than 1 year. Generally, assets are tangible, meaning we can touch them because they have physical forms. However, there is another type of asset known as intangible asset, which has no physical form, and it presents legal rights and relationships beneficial to their owner, like patents, copyrights, trademark, and goodwill. For definitions of liabilities, we have 3 keywords too. First, it is a present obligation, meaning it is an obligation that is we have a responsibility to do something, and it must be present, meaning it has already becoming our responsibility at present time. Second, it must arise from something that we have done or transaction in the past. And third, in order for us to settle the obligation, it will cause an outflow of resources from the business, meaning there will be an asset that we need to let go. Can you think of something along that definitions as a business owner? Let's say a loan provided by a bank to a business. Is it a liability to that business? Again, by referring to the definitions of liability, we can say that yes, it is a liability to the business, because after receiving the loan or granted the loan by the bank, the business is now having an obligation to repay the loan. And by that, the business will have to take its money to repay the loan to the bank, thus an outflow of resource from the business. So again, we can safely say that the loan is a liability to that business. Similar with assets, liabilities can also be classified into two: current liabilities and non-current liabilities. For current liabilities, you are obligated to settle it within the next 12 months, while for non-current liabilities, we are obligated to settle it within more than 12 months. So the basis of classifications of current and non-current for both assets and liabilities are the same.